Have you ever wondered why stock market crashes happen? Like a sudden storm on a sunny day, these crashes can seemingly come out of nowhere, leaving in their wake a trail of economic devastation. A stock market crash, in essence, is a sudden, drastic drop in stock prices across a significant cross-section of the market. This is not just a minor blip on the radar or a temporary downturn. Instead, it's a severe and dramatic drop, often triggered by panic selling, where investors scramble to sell off their holdings out of fear that prices will fall even further. Now, you might be wondering, why does this matter? Well, the stock market is not an isolated entity. It's intricately linked to the broader economy. When it crashes, it can result in a significant loss of household wealth and can even trigger a recession, affecting jobs, income, and the overall economic health of a nation. Panic selling and fear play a significant role in catalyzing a stock market crash. Imagine a crowded theater. If one person yells, "Fire!" it can trigger a stampede as everyone tries to escape at once. In the same way, if a few investors start selling their stocks out of fear, it can trigger a mass sell-off. This fear is often fueled by economic indicators, such as a decline in consumer confidence or negative news events, which can lead investors to believe that a downturn is imminent. But here's the thing, stock market crashes are not necessarily bad in the long run. Yes, they can cause immediate economic pain, but they also serve as a kind of reset button, correcting overvalued stocks and paving the way for future growth. This might sound paradoxical, but sometimes a crash can lay the groundwork for the next economic boom. So, while they might seem like economic catastrophes, stock market crashes are a natural part of the economic cycle. They're a testament to the volatile nature of markets, constantly influenced by a myriad of factors, from global events to human behavior. So, let's delve deeper and understand the historical perspective of these crashes. The first major crash that shook the world was the infamous Great Depression of 1929. It was a time when economic prosperity gave way to despair overnight. The boom of the Roaring Twenties, fueled by rampant speculation and a lack of effective regulations, led to a bubble that eventually burst in the form of the Great Depression. People were buying stocks on margin, essentially gambling on the continued success of the market. But the bubble couldn't hold. The stock market crashed and the economy went with it. Banks failed, businesses shuttered, and millions of people lost their jobs. The imbalance between the rich and the poor, which had been growing during the good times, was laid bare in the harshest of ways. The aftermath saw a decade of economic hardship and struggle, with effects felt worldwide. The Great Depression was a harsh lesson, yet it wasn't the last crash. Fast forward to the turn of the millennium, the world faced another crash, the dot-com bubble. It was a period of extreme growth and speculation in the stock market, driven largely by the rapid rise of internet-based companies, or dot-coms. Investors were clamoring to get a piece of the digital pie, and this frenzy led to a massive overvaluation of these companies. However, many of these dot-coms were not profitable, and their business models were often based more on ideas than on solid financial foundations. As reality set in, the bubble burst. Stock values plummeted, wiping out trillions of dollars in wealth almost overnight. Many companies folded, and the fallout was felt throughout the global economy. The dot-com bubble was a stark reminder of the dangers of over-speculation. It showed the world that while the internet and technology held great potential, it was crucial to base investments on solid business fundamentals, rather than just hype and speculation. In 2008, the world faced yet another economic crisis due to the housing market crash. This crash was a result of a complex interplay of factors, but let's break it down into digestible pieces. At the heart of the crash were subprime mortgages. These were home loans given to individuals with poor credit ratings, meaning they were high risk. Lenders, however, were eager to offer these loans due to the potential for high returns. Now you might wonder how such risky business was allowed. This brings us to our second factor, lack of regulation. Financial institutions were bundling these subprime mortgages into complex financial products, which were then sold to investors worldwide. These products were rated highly by credit rating agencies, giving a false sense of security. As long as housing prices continued to rise, everything seemed fine. Homeowners could refinance their mortgages or sell their homes at a profit if they couldn't make their payments. But when the housing bubble burst and prices began to drop, the house of cards collapsed. Homeowners were left with mortgages larger than the value of their homes, leading to widespread defaults and foreclosures. Financial institutions holding these toxic assets found themselves in a financial quagmire, leading to the collapse of several major institutions. The crisis quickly spread to the wider economy, leading to what we now know as the Great Recession. The aftermath was devastating. Millions of people lost their homes and jobs. The global economy was in shambles. It took years for the world to recover, and some would argue we're still feeling the effects today. The 2008 crash was a wake-up call for financial institutions and regulators worldwide. It highlighted the need for better regulation, transparency, and understanding of complex financial products. It's a stark reminder that when greed and short-term gains are prioritized over sound financial practices, the consequences can be catastrophic. Let's hope we've learned our lesson. The 2008 crash was a wake-up call for financial institutions and regulators worldwide. Now, we live in an era where cryptocurrencies are reshaping our understanding of finance. Cryptocurrencies, digital or virtual currencies that use cryptography for security, are the new kids on the financial block. They've taken the world by storm with their decentralized control, as opposed to centralized digital currency and central banking systems. But with this innovative financial tool comes volatility and potential risks. The value of cryptocurrencies like Bitcoin and Ethereum fluctuate wildly, often driven by speculation rather than intrinsic value. This volatility can result in significant financial losses for those who invest without a clear understanding of the risks involved. The infamous Bitcoin crash of 2017, where the value of Bitcoin fell from nearly $20,000 to just over $3,000 in a span of a year, is a stark reminder of this volatility. Another aspect that sets cryptocurrencies apart from traditional financial systems is the lack of regulation. This can be a double-edged sword. On one side, it allows for freedom from traditional banking fees and government control. But on the flip side, it can lead to illegal activities such as money laundering and tax evasion. Moreover, the absence of a regulatory body means there's no safety net. If a cryptocurrency company goes under, or if your digital wallet is hacked, there are no guarantees you'll be able to recover your investment. So, what does the future hold for cryptocurrencies? Some believe cryptocurrencies are the future of finance, a digital revolution that will render traditional banking obsolete. Others argue that the bubble is bound to burst eventually, resulting in a crash that could rival or even surpass previous financial crises. One thing is clear: as we continue to explore the potential of cryptocurrencies, we must tread carefully. The excitement surrounding this new form of finance should not blind us to the risks involved. As we venture into the uncertain future of cryptocurrencies, we must remember the lessons of the past. In conclusion, stock market crashes are more than just economic downturns. They're dramatic, often swift reductions in the aggregate value of stocks, fueled by a potent mix of fear, speculation, and economic instability. They're pivotal moments in our economic history, where fortunes are lost, lives are changed, and lessons are learned. We journeyed back to the Great Depression of the late 20s, a period marked by excessive speculation and a lack of financial regulation, causing a catastrophic collapse in the stock market. We saw how the Roaring '20s came to an abrupt end, plunging the world into a decade-long economic downturn. Next, we ventured into the new millennium, reliving the dot-com bubble. In this era, irrational exuberance and the allure of the internet led to a speculative bubble. Investors poured money into internet-based companies, many of which had never made a profit. When the bubble burst, billions were wiped off stock values overnight. Then, we delved into the housing market crash of 2008, a downturn triggered by risky lending practices and the proliferation of mortgage-backed securities. This crash precipitated the Great Recession, the most severe global economic crisis since the Great Depression. Finally, we explored the world of cryptocurrencies, a relatively new and volatile market. While they offer potential for high returns, they're also fraught with risks. From the meteoric rise of Bitcoin to the dramatic crash of other virtual currencies, the crypto market remains a wild frontier, with potential for both boom and bust. These historical events underscore the role of fear and speculation in driving market trends. They remind us that unchecked optimism, lax regulation, and risky financial practices can lead to disaster. But they also teach us resilience. They show us how economies can recover, adapt, and grow stronger in the face of adversity. They remind us of the importance of financial literacy, of understanding the forces that move markets, and of making informed, prudent investment decisions. Understanding these crashes and their causes can help us better prepare for future economic challenges.